everybody, welcome back to the channel. Today we're going to be talking about where to find deals in a down market. Actually, we're not necessarily in a down market yet, right?
Well, it depends on what metric that you actually use. Most people think that we are kind of in a recession right now, but it is a little bit unique because there's a lot of other factors that are coming into play. But ultimately, I think that we are really heading into a recession.
Yeah, and this is George Pino. Most of you probably know him. He's the CEO of Commercial Brokers International in Los Angeles, and my business partner. Now we've done, this is our third or fourth downturn?
Third downturn. Yeah.
Feels like five.
Yeah.
But all right, so we've invested through all of them. I think it's one thing you have to keep in mind. It can create a lot more opportunities, but where do you go to find those properties? Obviously, number one being commercial real estate agents ourselves. That's one place you want to start, is you want to connect with one agent, not 40, and really work with them and make sure they're giving you the deals. But outside of that, George, where do we go to find good deals? Okay.
Well, from history, let's talk about history a little bit.
We got a little bit of that.
It got a little bit of that. Every time we've ever gotten into gone into a down market, or if there's any kind of blip, first thing we always hear from investors is, I want an REO. I want a foreclosed property.
Oh, yeah.
Yeah,
that's already started, actually.
It's already started. I think it's going to be a lot more difficult in this next cycle to actually find a lot of the REOs.
Well, hold on one second. OREO and REO definitions.
Yep. So REO, real estate owned, that, and then some banks call it, because banks also own their own property sometimes, OREO, or other real estate owned.
Yep.
So it
banks.
Yes, it is essentially a term that banks use when they foreclose on a property and they own it now. Yep. So we get a lot of people asking for these foreclosed properties. Yeah. The problem that you run into is that, right now the banks have gotten pretty astute over the last downturn back in 2008-9 was all about the banking industry. It was all about the debt and equity. Since then, the banks have gotten really astute about how to actually structure their debt. And, if there are areas or times when, for instance, a loan may be coming due, and instead of calling, if they can't refinance, instead of calling the note due and then foreclosing on the property, a bank may just extend that term. Yeah. So to keep them in good graces, extend the term, extend it out. They may actually even on some variable rate notes, instead of taking over a foreclosed property, an owner can actually potentially go back and say, you know what, can we reduce the interest rate right now a little bit more just to keep me through it and blend it out? Yep. So they've gotten very astute, and they really want to work with the actual owners as opposed to foreclose on the properties. So that makes it a little bit harder sometimes for
there's going to be a lot of opportunity there, isn't it?
Absolutely.
Because all these loans that, they've come to term, and people need to refi, and interest rates get up to 6, 7, 8%. They're probably not going to be able to refi. So it could be a good opportunity to be calling on those property owners.
Absolutely. And this is where it's so important. You said earlier, choose one broker. Now, first of all, definitely choose one broker, because if you have multiple agents out there looking for you, and speaking of this, it's going to cause issues when it comes to the sales side. It actually takes a little bit of your credibility away as a buyer.
They'll run into each other, and your name will come up, and then you won't get any deals.
So, those are the type of properties that your agent should be targeting. High vacancy properties, because now we're having cash flow issues. The other one are, just like you mentioned, properties that have variable rate mortgages, especially if they were just financed in the last 3 or 5 years, or 3 or 5 years or more, because that's typically most loans have a 3 or 5 year fixed rate period if it's a variable rate loan, and they start going into the variable rates and interest rates start rising. So, and as the interest rates rise, of course, their returns go down, and also when you start looking at debt service coverage ratios, it's going to require more of a down payment, and that goes into the third issue, which is, as you mentioned, commercial loans come due every 10 years typically. Unless it's a fully amortizing loan of 15-year amortization, most commercial loans always have to be refinanced. They come due with a balloon payment at the end of 10 years. So, of course, multifamily exception. They have fully amortizing loans up to 30 years. Right. So with that, those are what type of properties you want to target. Now, understand though, most of the properties that are going to come on are going to be the high risk properties initially.
Yeah.
You know, because they're the first ones to get hit hard, the ones in tertiary markets and whatever. So let's talk about how to mitigate that risk now that you're looking at the properties. So, you know, initially you're going to see these properties in, you know, really like tertiary areas or properties that are not really doing as well. They're going to have issues. They may continue those issues. They are typically the first ones to get hit hard and the last ones to come out of the market. So you may want to wait a little bit just to see what's happening into certain other markets, because to mitigate it, what you want to do is, one, I would plan for higher down payments so that this way you're not worried about cash flow in case something the market still goes down a little bit more, so you have an extra vacancy or whatever may happen, that you're not going to lose that property that you just acquired. Look for higher down payments, even paying cash. Expect and build a war chest for low cash flow.
Yeah.
You know, just in case that happens as well.
Sure. Well, I think a lot of people, the fundamentals.
Yeah.
People got away from It's been pretty easy to make money in real estate the last 11, 12 years, right?
Absolutely.
People got away from fundamentals.
Yep.
Find the people that got away from fundamentals.
Speaking of which, that's my next thing, actually. It's creating a marketing plan for your exit strategy.
There you go.
Because most people never did that.
Yeah.
You know, they were just riding the wave of the real estate keep going up and up and up. So, you know, it was almost more speculation versus investing.
Yeah.
So really you have to create that marketing plan for repositioning the asset or exiting the asset. Lastly, a good way to mitigate risk is look for high growth population areas.
Yeah.
You know, because basic laws of supply and demand, if you get the demand out there because more people are moving in there, so you need more office space, you need more retail space, then your rents are going to potentially rise or rise quicker than other areas in the United States. So that's, I think, a way that you can mitigate the risk and how to find the properties.
Yeah, you've got to really, it goes back to doing your due diligence before you acquire the assets.
Yep.
And it's like I said before, it's been pretty easy because the market kept going up. But now if you're not looking at traffic count, walk score, occupancy, vacancy, you need to make sure you're looking at all of that before you acquire the property because, you know, there's nothing worse when the rents start slowing down and not coming in. And so doing the right due diligence before you buy the property is going to help you eliminate a lot of those headaches.
Absolutely. Absolutely.
And it's key to that. And, you know, talk to a lot of people. Talk to the broker that you're talking to. Get on lists. Get lists of people that have got loans, and you know, get a good title rep as somebody that you can work with, and build that team around you so you have everybody and they can continue to bring assets for you to take a look at.
No, I think those are all really good points. And really, you know, as you said earlier, I wanted to kind of jump back to that a little bit. We've invested all throughout downturns, upturns, upticks in the cycle. It's really not necessarily about timing the market if you do all the real estate fundamentals and you really plan and have an actual business plan. Just like any kind of investment, you should have a business plan. You know, you're opening a business, you should have a business plan to guide you what steps that you're going to take. Same goes with the investment. So stick to those fundamentals, and I don't think you can go wrong. There will be opportunities out there. You just have to take a little bit closer eye, bring that wider net and magnifying glass once you find it.
Cast a wider net, find them, and then once you find them and you find the property, really do the due diligence on the tenants that are in there. Who is actually going to be there, and are they going to be able to continue to pay the bills? So, all right. Well, George, thank you very much for this. I think it was very informational. We've got a lot of videos like this on the YouTube channel, folks. So if you haven't checked it out, make sure you do so. Thank you for tuning in today. George, thank you for coming on.
Thank you.
And if you haven't done so, make sure you subscribe.